Hi, welcome to Dorchester Advisors. Thanks for joining me on this quick market update about the third quarter of 2025. I think you'll get some interesting investment insights. Now, in case we haven't met before, my name is Dushyant and I am the founder and managing director of Dorchester Advisors. We work with individuals and families and help them build solid retirement portfolios that are capable of providing them with enough money to sustain their lifestyle through retirement. So what happened in Q3? Well, the big picture was positive. Most major asset classes rose in the third quarter and indeed year to date, with US equities and emerging markets leading the way. My takeaway: a well-diversified portfolio remains one of the most reliable ways to preserve and grow your wealth. Now, compared to the first half of the year, quarter three was relatively calm. Remember, earlier in 2025, we dealt with the trade war in April, the rising tensions in the Middle East and Ukraine, and even US airstrikes on Iran's nuclear facilities. By contrast, this quarter three, was quieter. The most significant development was the passage of the OBBB, the tax bill, which provided some much needed clarity for investors. So looking ahead, I expect 2025 to finish on a positive note. I'm seeing several encouraging trends. Company fundamentals remain strong, earnings, margin, balance sheets are all healthy. There's a high likelihood of a federal rate cut. The new tax law gives investors a much clearer outlook, and enthusiasm for AI-related investments continues to attract significant capital inflows, which are buoying the entire market. That said, there are risks simmering in the background: the trade war and tariffs, ongoing conflicts in the Middle East and Ukraine, unsettled US politics, and the government shutdown. But I expect these risks to have more impact in 2026 rather than this year, yet they remain very important to monitor. Earlier this year, I said I don't plan to make significant portfolio changes until markets settle, because trading during turmoil often amounts to market timing, and that rarely works. So far, this discipline has paid off. Of course, unexpected events can always happen, but for investors with well-structured long-term portfolios, these short-term shocks should not be a major concern. Our portfolios remain broadly diversified with exposure to hundreds of leading companies around the world, across key sectors, across key geographies, across different sizes. Now, they may fluctuate as the markets fluctuate, but over time they will grow as economies prosper. So a long-term philosophy remains this steady. Diversify across the 5 major asset classes. By the way, these asset classes are cash, bonds, equities, real estate, and commodities. 2. Maintain an equity bias to capture growth. And 3. Relentlessly focus on costs. This approach has been effective for building and creating reliable retirement income. Finally, please know that I continually monitor the markets and portfolios that are entrusted to me. Thanks again for watching. I invite you to look through our website, and if our philosophy and ideas resonate with you, give me a call. No obligation. I love talking all things invested. Thanks for visiting.